right, we are just going to chill here for a bit until 8 o'clock, and you can say hello in the chat if you want to. We don't have to talk about anything specific, just chill for until 8. If you guys can leave a comment, say hi, then I can say hi back, and then we can get this party started. All right. So crypto is an interesting topic, which we will get into shortly. I'm quite excited. Okay, we've got some viewers coming in. That's very good. Okay, let's see. Check out what's going on the other social medias to see if anybody's gonna come through. Okay, I should probably put out a comment on the Facebook. Going live now. Copy and put this in. How's it, Caleb? Nice to see you. Welcome all. Five more minutes, and then we're going to kick off this tax on crypto session. See what's happening on the Twitter. Hey, 7 years viewership is climbing. Very good. Look, to be honest, tax is... People say tax is it's a grudge, which it is. It's a grudge to pay tax. But it's quite a simple thing to understand once you've got the concepts for it. So... or understand the framework. If you understand the framework, then you can understand tax. And if you understand tax, you're much more likely to be compliant, which is quite cool. So hopefully if I do a proper job explaining the tax implications of crypto and what happens when you buy and sell NFTs and the unique challenges that we've got in the crypto space, then perhaps people will be more likely to declare what they have and souls will be happy, you will be up to date, and you'll have peace of mind about what's happening in your crypto stuff. But let's give it 4 more minutes, and then we can start it off properly. I'm going to slide this thing over here, and then we can do it like this. So this is great. Let me just get to my notes. Okay, notes are going. Can everybody hear me fine? I just want to check sound quickly. Just say hello or leave a thumbs up or whatever if you can hear me fine. By the way, for interest's sake, I just want to test this quickly. I don't know, but can you hear this? Okay, I'm just going to play A minor. Can you hear that? Or is it soft? It's probably too soft. Yeah, I thought the guitar was quite soft. Okay, cool. Yeah, I still need to figure out how to play guitar live. That would be quite cool. I just don't have the proper mic set up for that yet. But that's not what we're doing tonight, is it? We're talking about crypto. And the theory of taxes on crypto. But we'll start very, very soon. My coffee's finished. I'm an iDad, so coffee's done. So the caffeine is already kicking in. But thank you all for being here so far. The guys that's early, the people that's early. Thank you for popping through. It's quite funny. On Twitter, when I announced that tonight we were going to do this crypto thing, I told everybody, I made it perfectly clear, tonight, 8 o'clock, we're doing part 2 of Tax on Crypto. Wouldn't I get a comment where somebody asks, which time is that? And so I don't know whether I was unclear when I said, it's, 8 o'clock. It was 8 o'clock GMT, plus 2, 8 o'clock in the evening, 8 p.m. I don't know how to make that more clear. But I thought that was just funny. Ask what's the time, what time is it, and I already made it clear what time is it. Okay, 1, 2, 3, here we go. Thank you everyone for being here. There's currently 8 people, 8 concurrent viewers, which is nice to see. It's Monday evening. I hope it wasn't a blue Monday. We did start off with the tax Indaba today. So today, tomorrow, and then on Wednesday it's a tax Indaba, which is like the biggest tax event of the calendar. And so there are things like tax events, and it was quite interesting. There was about 500 people on there, and yeah, it was nice to be there on day one. And what really frustrated me about when I saw the program for the tax Indaba was like, okay, so you're going to have a tax Indaba in 2021. Okay, and I hope SIT is not in the chat or isn't in the chat yet. But what surprised me completely is that cryptocurrency, or the discussion of cryptocurrencies and NFTs, non-fungible tokens, are not on the program, on the events program. I was like, what the hell is happening? Why? How can this be? Why is crypto, like, it's the biggest, like, easily, it's one of the biggest things that's happening in over the past, I'd say, 2 years. And the tax space, like the people in the tax space, there's still so much misinformation about the taxes on crypto. Okay, so let me first lay out a complaint here that I've got about the taxes on crypto. Let's do that. All right, my complaint for now is there are a website or a news site called I think it's Business Deck, or it might be Business Deck. Any case, so it's very, very, very simple. In their articles, they post there that the tax on crypto is 45%. This is extremely frustrating because, as I've said on Twitter, for those who follow me, to be taxed at 45% assumes two things already. Number one, it assumes that you are making such big trades, that you're a crypto trader, number one. And number two, that your trades or your salary is of such a magnitude that you are taxed automatically on the 45% tax bracket. And as we all know, taxes for individuals are a sliding scale from 18 to 45%. Not 45%. Why the tax articles comfortably just forgets about that, the fact that, it's 18 to 45 and not just 45%, is one frustrating point. And the second frustrating point is to assume that everybody is a trader. And that is so far from the truth. So let's go to the first thing about the taxes on crypto. Now, I think what SARS have done, and what I'm quite happy with or happy about, is that SARS has actually identified or defined what cryptocurrency is from a tax point of view. And so cryptocurrencies from a tax point of view is defined as a financial instrument. Financial instruments fall into the same category as shares, debentures, loans, things like that. What makes that nice is it gives us a good framework about how the tax of crypto would be handled. The major difference between the taxes on cryptocurrencies and what you do with your crypto versus what you do with your shares is there's mainly two things. The first one is that the holding of cryptocurrency doesn't benefit off the 3-year rule. Now, the 3-year rule says if you own shares and you keep those shares for a period of 5 years or for a period of 3 years or longer, they will automatically be considered capital shares or capital gains shares for capital gains. Okay, that rule does not apply to cryptocurrency. Okay, so cryptocurrencies do not benefit from the 3-year rule. However, I think the 3-year rule is a very good framework. There's very little reason why you would hold on to a crypto for 3 years and then still tax it as if it's a trading coin, as if it's a coin that you are selling with the intent of a trader. To me, if you hold something for 3 years, it's very likely that that specific coin that you've held for 3 years is a capital gains item. So that tells us, okay, and the other thing, so the first difference between shares and cryptocurrencies is that cryptocurrencies do not benefit from the 3-year rule. The second thing is that the buying or investing in cryptocurrencies are considered by SARS a suspect trade. So what that means is if you're doing crypto related trades, if you're a crypto trader or you buy crypto with the intent to trade, to do business with, rather than to invest, if you make losses, those losses can be ring fenced. So a very basic level explanation of what ring fencing means. Ring fencing means the loss on the crypto cannot be deducted against your other taxable income. So if you have a non-suspect trade, a normal trade, let's use the word, if you have a normal trade, then if you make a loss on it and the loss is allowed, then you can apply that loss against your taxable income. Okay, so you get a bit of tax benefit there for your loss. But that unfortunately does not apply to cryptocurrency. So those are the two main differences between the taxes on cryptocurrencies and the taxes on shares. Okay, so that is step one, the difference between those two. So let's then go over to all the taxable events of cryptocurrency. So the taxable events of cryptocurrencies are the following. Number one is the moment you buy cryptocurrency on any exchange, whether it is Luno, Valar, CoinDesk, Altcoin, Binance, any type of platform, or however you get the coin, then it becomes one of two things. It will either become a base cost item. So I'm going to use DICE as an example. It will either become a base cost item, or it will become a revenue item, so cost of sales. Okay, we'll go into one of those two categories. The category in which it goes into your purchasing of those cryptos. So what makes it either a base cost item or a trading item, a cost of sales, so inventory basically. What gives it that difference depends on taxpayer intent. So let me put it into the chat. I'm going to type here ipsi dixit taxpayer intent. Okay. So you can look up ipsi dixit. Ipsi dixit is what you intend something to be without necessarily giving any proof for it. So it's what you assert something to be as. Okay? Now, so that means that you could be a trader, a crypto trader, or you could be a crypto investor, depending on the intent of that individual coin that you bought. So, for example, if I buy one Bitcoin today and I decide to do something to go in and out and start doing business with that one Bitcoin that I bought, and I'm in and out, and I'm doing this with Ethereum, and I'm turning this into that, and turning the Bitcoin into Doge, and then I'm doing some stuff on XRP, and then I'm doing all these different things with that one Bitcoin that I bought or whatever, and I'm very busy and I'm very active, and my intent throughout this is to try and make quick day profits. Profit. That's all I'm about. Okay? That shows that is really an inventory item. Okay, that's a good example of an inventory item. However, when I buy crypto with the intent of investing, you'll notice that my demeanor is much slower. Okay, I buy the crypto. Let me see what happens. Okay, I let it sit maybe for a few weeks, maybe a few months. Oh, it went up. okay, the market is doing really well. Maybe this is a bull market. Let's see if a bull market continues to run. Okay. I think I'm going to exit my position and then take whatever I made and then decide I'm going to buy something else from it. Immediately, there's a difference between the first example that I gave, where your movement, it's as if you're a business, right? If you're a shoe store and you buy shoes, your intent is to move that shoe as fast as possible from the rack out of the store and get money into your hand. The same with crypto. If you buy crypto and you put it into your rack and you want to, whether you are selling it to fiat or whether you are disposing it to get other types of shoes into your rack, you can see there's that is clearly an intent. However, if you are buying a pair of Nike Air Force Ones and you decide to keep them, you're gonna run with them for a while. You're gonna cherish them for a bit. You're gonna keep them clean, and that type of a thing. That is a clear investor intent. Okay, so you must know, what do I do with my crypto? What is your ipse dixit? What is your taxpayer intent behind the purchases? Okay, so I'll cover Bitcoin. I'll cover the mining of crypto a bit later. Okay, so now we've handled what happens when it becomes a base cost or an inventory item. So what are taxable events that creates problems for us in terms of whether there's any tax implications of the crypto that we've bought, or however we earned the crypto, whether it's through staking, whether it is through airdrops, whether it is through mining, however you do your crypto stuff. Okay, so we have determined the cost value. Okay, so either it was base cost, X amount of, So it was either base cost or it's inventory. Okay, so the first taxable event is when you sell the coin that you have, or the currency, and you turn that into fiat. You turn it into cash money. Okay, so you exit your position and literally this money goes into your bank account. That is the simplest form of a taxable event. That's tax event number one. Taxable event number two is taking some of your coin, and let's call it Bitcoin, and you turn that into a different coin. That's taxable event number two. But what happens when you turn the one Bitcoin into X amount of Ethereum? You have basically sold one Bitcoin and bought X amount of Ethereum. So then that Ethereum creates a new base cost or inventory item, depending on your reasoning for buying the Ethereum. So you can see every transaction that you do from one crypto to another turns that into a new base cost or inventory item. And the simple reason for that is because cryptocurrencies, or whether it's Bitcoin, XRP, whatever your coin is. Sorry, I lost my train of thought. So then the cryptocurrencies immediately turns into an item that you can then sell again. Okay, so that's taxable event number two. Taxable event number three are ways in which you earn crypto, which are, and that is not necessarily trading, but it is a way to earn crypto. And those are things like staking coins, airdrops, and mining. And there's a lot of examples where you earn crypto for whatever reason that might be. Okay. When you get those type of coins, okay, they will automatically be gross income items. Okay, so the moment you've mined a coin, that creates a revenue item. It's money, or it is income that you have earned through mining. Okay, the same with staking. Okay, so staking is very similar, is very similar to interest. Okay, the same with airdrops. There might be airdrops. You might get X amount of some type of coin. It will have a value at a particular date, and then that is a type of an income. All right, but it's important that if you're a miner, a crypto miner, and you obviously have expenses. You might have a machine like I do, or I don't have a crypto machine. I've got a computer, but you obviously spend some money in order to mine the coins that you are mining. And so then you can obviously deduct expenses against the mining income, against the coins that you've mined. But now it's very important. It's very important to note that the coins that you've mined automatically turns into either, again, a base cost or a inventory item, depending on whether you're an investor or a trader. That thing is not going to change. Also, if you earn a salary and somebody paid you in a cryptocurrency, then that will be taxed as a gross income. So that's basically straightforward. It goes into your wallet, and then you've earned those coins, and it will have a value, and you'll be taxed at that. But the other side of that is, again, those coins that you've earned, it forms part of your base cost and inventory, or base cost or inventory. So, and then a few other taxable events is if you donate cryptos to somebody, that will obviously have donations tax implications. And if you sell your crypto in order to buy goods and services, okay, so that creates another taxable item. Okay, so we've covered a lot of the common taxable events. I will address the questions a bit later after the training session. So thank you for your patience so far. All right, but thank you for everyone that's here. We are carrying on to part two. All right, so the unique problem that you have with crypto, the essential issue that you have with crypto is a lot of people became active in the market, in the crypto space. Say, for example, it was back in 2017. Okay, so you bought and you've done some stuff with your crypto since 2017. You've done some things in 2018. You've done some things in 2019. That repeated, and you did it all up until 2021. And now we're sitting 2021. And now all of a sudden, you must have a plan. You must somehow declare those things that you did in the past. So in my consultations, the Tax Maverick is a consulting company, and I do consult on this about how do you go about declaring it, how do you fix and how do you go about it. We can certainly assist in that, but very simply, if you were active with your crypto in 2017 and 18 and those years, I would argue that it is still important to declare those activities on those returns. especially if you haven't done so. And the reason why I say that, and this is very simple, is there was 1 year that I think crypto took a bit of a dive. I think it was 2018. Any case, so what happens when you don't declare anything? You don't declare anything. Okay, sorry, that was very silly. But what happens if you declare your crypto and you made a loss? You sold at a bad point. You made a loss on your crypto. Now, if you don't declare, you lose out on your loss. You lose out on the crypto loss. So if you made a crypto loss in 2017 and you declare it, that loss can be pulled forward to 2018. Okay? And then that loss can be used against other gains that you've made. Okay? So that is why I do recommend that if you were active on crypto for some time, that it might be worth your time declaring those it might be worth your time declaring those crypto transactions that you've had in 2018, 17, 18, 19. The only homework, the only additional work that would be required of you is that you would need to resubmit those returns. And problem number 2 is that you would need to know, how do I declare the cryptocurrencies? Okay, how do I declare the cryptocurrency that I've done? Whether it was mining, whether it was staking, whether it was airdrops, whether it was just simply buying and selling, whatever. How do I declare it? Okay, I've done quite a bit of homework. And unfortunately, the way it works with crypto, with shares, the nice thing is if you've got a share portfolio, your traditional investment platforms, you've got, Alan Gray, Coronation, those guys. When you've got a trading account with them, or you give them a certain amount of money to trade on your behalf, whatever the case may be, they're allowed to use the weighted average base cost method to work out what would the capital gains tax be. What would it work out to be? And then you can simply work out what's your capital gains that you're supposed to pay on your investment. The same thing doesn't exist for crypto. For crypto, you're not allowed to use the weighted average base cost method. Okay, so what is the weighted average base cost method? Weighted average base cost method is, it's basically takes up all your base cost items. It works out an average based on weighting, based on how much each year, and then it works out what is the rough base cost that you can use for all your for all your exit positions of your shares. But with crypto, you're only allowed to use one of two methods. Specific indication is option number 1. Option number 2 is first in, first out. Now, you can understand that if your first exit position from any crypto, whether it is that you moved from one coin to another, or you decided to exit completely from your positions, and you only did so in 2021, but you've had a lot of buying transactions stretching back till 2017, that your first out option is based on 2017's numbers. And that's crazy, okay? So the Income Tax Act does allow you to use specific indication method. And that means specific indication means you can say which coin was sold at what date. So that's quite cool. So that means if you bought, and so that's how you can work out the CGT in that way. But that's how you work out the capital gains, and you have to do that with your crypto tax, with your crypto history, which you can download. Valar, both Valar and Luno has direct relationships with SARS, and they can and basically you can download your share transaction, your crypto transaction history directly from their sites, and then you can work out what was all your movements between crypto, what was your sales, what was all the purchases that you've done, and you can work out, okay, what's the tax going to be. But that can take you quite some time to work out yourself. So Tax Maverick, we are creating a a tool that people can benefit, and we hope to launch that sometime in the near future. I want to make no promises at this point, but that is in the pipeline. So you've got an inherent problem with working out just simply declaring that for capital gains tax. Okay, mining and all those other different ways of earning crypto, you have to work out what is the value of the coin at the time it came in, work out how much income that would be on the date, do that over 12 months, work out your expenses that you've got, and then you somehow have then you've got something to work with. Then you can actually pay tax on your trading income. If you're a trader, a crypto trader, you obviously can't use that base cost method I just explained. If you're a crypto trader, you have to treat your crypto purchases as inventory. You have to keep very good books about which coins did you buy when. You've got an opening balance, you've got a closing balance, and then you've got purchases throughout the year. And so that way is much more complicated than simply people investing into crypto. That's why my opinion is that anybody who's doing anybody is doing trading, I normally recommend to put that into a company, into a PTY, and especially if you've got a fairly large quantum. And here's the reason: if it's in a company, the company forces you to have financial statements. Very simply, because financial statements forces the accounting firm. Now, it will cost you some money, so hopefully you're making decent profit. But then it forces proper bookkeeping and proper accounting to be done to actually work out what the profits will be, and what the tax on that would be. It's 28%, but it's a flat 28%. And unless you've got 3 or more employees, a company is not that tax efficient compared to an individual. Okay, so we've talked about the challenges of declaring your crypto, whether it is capital gains tax or all those various forms, whether it is mining, staking, airdrop, trading, whatever it is you do. Okay, let's talk about the next topic, which is possibly my favorite topic to consult about or to teach about, and that is the 3 levels of disclosure. Because everybody in tax consultations have asked me, okay, so what if SARS audits me? What will happen? Or how will SARS know? Or it's all those type of questions where how will SARS XYZ with what I submit on my tax return? Or if I just submit round numbers, how will SARS know? Or what is SARS going to do with the way I declared it? And is it correct? Okay, so option or disclosure level number 1. The first manner of disclosure is what you tell SARS on your tax return. It's simply what you submit on your tax return, and that is whether it is proceeds and base cost, which is capital gains tax, or it is trading, which is all those other forms I spoke about. Okay, and on your tax return, you put on you declare on there round numbers. There's meaning there's no Excel sheet that you're sending them to them yet. It is simply round numbers you're putting in there, but obviously you have to have some workings, but it's round numbers. So that's disclosure level number 1. Okay, I'll put this in my book. Disclosures, 3 levels of disclosure. Okay, disclosure level number 1. Now disclosure level number 2 is where SARS might ask for supporting documents. I'm saying might because if you are declaring crypto on capital gains tax, if you are declaring that to SARS, if you don't have other red flags that's standing out, so for example, you might be a commission earner and you've got some expenses that you're claiming, or you've got travel allowance and SARS going to audit that, there's a strong likelihood that SARS might not ask for your supporting documents. And that's quite cool, because if they don't ask for your supporting documents, do you know what that means? It means that that SARS isn't probably going to audit you for that year, which is quite cool, unless later on, they can change their mind and ask you for supporting documents. But that is the great thing, is at that second step is they can say on your assessment you weren't selected for verification, which is amazing. Okay, so you weren't selected. That's disclosure number 2. Now at that level, let's say that you were selected. Let's say that you were selected for audit or verification. What I do and what I recommend you do is you submit your basic supporting documents, your RP5, your medical aid, your RA, and then what you do for your crypto, and this is really, really, really important, you send them a very nice looking PDF, whether and you PDF it from Excel or wherever you did your calculations from, and you send them the simple calculation, your name, your surname, your tax number, your tax year, followed by cryptocurrency, proceeds total amount, base cost total amount, and you work out the capital gains, and you PDF that and you send that as a supporting document item. You don't have to give SARS more than what they need in disclosure level number 2. The reason I say that is if it's neat, if it's clean, if it looks like you've done a proper, if it looks like it was done by an accountant or by an auditor or by a tax person, that is the way you want it to look, because we are quite good at making SARS look away from stuff. Okay, so that's disclosure number 2. You give SARS exactly what you've submitted on your tax return. If you submitted an RP5, you submit your RP5. If you had medical aid on your tax return, you submit your medical aid. If you've had RA, you submit your RA. If you've had rental income and expenses, you submit a simple summary spreadsheet of your rental income and expenses. Nothing more, nothing less. So that's disclosure level number 2. That's pretty cool. Okay, that means if SARS then say, okay, we are going to send you a completion letter, meaning they are happy with what you've submitted at disclosure level number 2, then you've skipped. You can, make a skip, and then you're all clean for that year, because SARS is happy with what you've submitted, and they don't go to step 3. That is amazing. But what if they go to step 3? Now this is the point where SARS needs to say exactly what they need from you. If they say you've declared some crypto, we want your crypto transaction history. We want that all the way. We want that from Luna or from all the exchanges. Then just send them everything in whatever format you can. But the important thing is SARS must give you reasonable specificity about exactly what they want. Okay, if you submitted rental income and expenses and you've got interest there that you're claiming, and they ask for the proof of the interest, you send them the bond statements. So you simply comply to what SARS asks for. So what is the point of the 3 levels of disclosure that I just explained? The 3 levels of disclosure means this. SaaS has to jump through 2 difficult hoops before they even can touch your crypto transactions. Okay, so the 3 levels of disclosure, the way SaaS have to jump through the hoops is the way that you avoid needing to submit your everything that you've done on crypto. And more than that, then it becomes advice, but that is just the teaching part about the 3 levels of disclosure. Okay, so I'm going to go through a few questions first here, address them quickly, and then we are going to go over potential tax structures for crypto stuff. Okay, let me see here. All right, how would you see mining one coin and then moving it to an exchange to purchase a coin or token for long-term holding? So, okay, very simple. When you've mined a coin, it is immediately taxable in that tax year minus expenses that you incurred in order to earn that one mining coin. And then once you've moved that coin, then you've basically sold that coin. So when you've mined the coin, it created a base cost or an inventory item, and then if you sell it, that will create a taxable event. And then once you've bought something else, it will create another. So every time, the moment you've taken one coin and you turn into something else, there's already a different taxable event. Okay. Do deferral rewards on a daily basis also count as taxable event 3? Yes, because that is considered revenue income, Tyron. So revenue income is the type of income that happens regularly, whether it is through airdrops, airdrop staking, however you earn that recurring income. That is why mining is a straight income item, is because it's done regularly, on the regular, almost like a trader. Okay, it's like your job. Every month you remove interest. How to prove SaaS that the graph of principal is just okay, complex. Can I ask for a refund on my they're all red. Yeah. Thanks KK for coming out. I would also like a refund on my crypto investments. That would be quite nice. All right, let's look at potential tax structures. This is where you have, or you are sitting on, quite a large quantum of crypto. You are sitting on quite a large amount, and you've accumulated this over a few years. You're sitting on 5 million, 6 million, 10 million, 12 bar, whatever that big amount is. You inherently now fall into the category of what we call a high net worth individual. Now, a high net worth individual needs to make a plan for 2 things. Number 1, and the biggest one of all, tax planning, because you will probably be ruined if you were to pass on with estate duty. Okay, so that's a flat 20% on the amount that's more than 3.5 million. So you need to make a plan with what you have and move that into something that's not affected by estate duty. The simplest form of tax planning is a trust. Now, to cover trusts very quickly, if you put something in a trust, you obviously need to get the crypto into the trust in some way. But you either sell it to the trust, you either donate it to the trust, or you can make a loan with the trust. But all 3 has their own unique challenges. let's assume you've moved your large quantum into a trust. The nice thing of a trust is the capital gains can now be split to the beneficiaries. So you actually split the tax implications to whoever's the beneficiaries within a trust. Okay? In that way, the trust doesn't pay 45% tax, but the individuals who eventually benefit from either the capital gains or the crypto trading or whatever you do with crypto, they can they get however they get the crypto or however it's distributed to them, they are taxed at their rates. So that's option number one. Option number two is there are more complicated structures where you can use I can't get to the exact name now, but there is a way where you involve a foreign trust, and you've got foreign dividends in the mix there. And if it's below a certain amount, then the foreign dividends that you get from that will be tax exempt. But that's too high level for this conversation. Okay, so there are things that you can do. Again, like I said, if you're a trader, if you do trading, if you do mining, and your mining is doing really well, I would recommend a PTY, but the PTY has to make sense. So if it's a proper company that's making good money, that can afford it, you can actually decide to have some employees, turn it into a proper business, and then you could be taxed on SBC rates. There's other benefits to a company, and the other benefit of doing crypto is that it has no VAT implications. Okay, financial instruments are exempt from VAT. So that's the other nice thing. So that's the basics on structures. Before I go over to the taxation of NFTs, we get to the point now in the chat. There's 15 minutes left of this teaching, and then we're going to go over to Q&A. So let me address a few of these questions here. Is there a set amount where your gains are considered income or CGT, or is it solely based on ipse dixit? Rash, it is wholly and solely dependent on ipse dixit. Wholly and solely dependent on your reason for investing or your reason for buying crypto. The thing that I would love to see in the courts one day is that this is tested, where ipse dixit is tested, and what was your intent and can you prove it? And number of transactions isn't necessarily the thing that makes you a trader. You could have quite a few transactions, but that doesn't make you a trader. A trader literally considers what they do in crypto as their business. It's the way they make their money. It's a business to them. Okay, and SARS will do what they can to turn your crypto into trading, but don't let SARS push you around. If you've got a strong ipse dixit that can be argued, that you would be able to argue, here's a correct argument. Okay, if you have a strong enough argument that can support your ipse dixit in court, then go with that. That's the answer there. All right, let me see. What are the tax implications if I move all my cryptos from an exchange to a hardware wallet? Well, I mean, you haven't sold it yet. So you simply moved it off the exchange and it's now on a hardware wallet. What do you do with the wallet then? It's as simple as that. What do you do with the wallet? Do you give it to a friend? That's donations tax. Do you throw it in the ocean? Whoops. Okay. It depends on what you do with the wallet. It's not like you buy crypto on the exchange, then put it in the wallet, and suddenly it doesn't have any tax implications anymore. Like that doesn't happen. It still has a value, right? If okay, very, very, very simply, imagine this is a USB stick. It's not a USB stick, okay? This USB stick, if it's got a contract in it, okay, if there's a file, there's a PDF file on this USB stick, but that file is actually nothing, then that USB stick, the value of the USB stick is the value of the USB stick. It's what it would be sold as if nobody knew anything about what's in it. Okay. However, if you have a PDF that is actually a contract, but it's a contract that you signed and it's worth 2 million rand, that contract, that USB stick to you, and you know what's in it, is worth 2 million rand. Okay, there's some, I think it means if sending your coin from an exchange to a hardware wallet for long-term holding and cold storage. Okay, so it would, so let's say you take your 10 Bitcoin, which you bought for, I don't know, let's say you've got 500,000 rands worth of Bitcoin that you bought on the exchange. Then you send your crypto, those 10 Bitcoin, to a hardware wallet. Okay? The value of that is still 500,000 rand. Okay? Nothing has happened yet. So, but you must take into account what you've done with it, right? If you've taken something off an exchange, it's your responsibility to tell your accountant or your tax person or your whoever's responsible for your taxes. They would need to know that thing, that one line, is where you moved your crypto or 500,000 worth of Bitcoin onto a cold storage wallet. There will obviously be implications once you do something with that cold storage long-term holding. Okay. Right, let's go over to part 2, and which is the taxation on NFTs. So, NFTs are not defined. NFTs are not defined yet by the Income Tax Act, and I don't think NFTs will be defined anytime soon. So this is wholly and solely my opinion. It is not tax advice. Please don't take it as such. The way I would see the buying and selling of NFTs is, if you bought an NFT, obviously you bought NFT with a certain amount of Ethereum, so you've sold some Ethereum in order to buy the NFT. So selling the Ethereum will have a taxable event. Then you bought the NFT for a certain amount, and then if you sold the NFT, there will be, in my opinion, a tax implication. Andre Botma, the tax maverick, will go out on a limb and say that I would personally define the selling of an NFT, or I would personally define an NFT as an intangible asset, and it will have a capital gains tax event. Not many people will agree with my reasoning there, but here's why. It's the same reason why crypto is considered a capital gains tax item and not a personal use asset. Why? Why did SARS define it as a financial instrument for capital gains purposes or for trading purposes, whatever it might be, depending on those two categories. But why is crypto taxed the way it is and not as personal assets? Personal assets depreciate. Almost all personal assets depreciate. If you buy a car, you drive it out of a showroom. 3 months later, it's been depreciated in its kanonin. Okay? If you buy an art piece somewhere, but it only has value to you, and then eventually you sell it, it depreciates. Okay, so that's a personal use asset. Almost all personal use assets that's defined in the capital gains section. House is not an asset. Anyway, guys, so personal use assets. The reason why they normally don't have a capital gains tax event, or why they exclude from capital gains tax, is because it depreciates. For example, this guitar I bought for a certain amount. If I sell the guitar, I will probably get less money for it, unless it becomes an antique. But it's a personal use asset. It's more likely to depreciate than appreciate. The reason why I, the tax maverick, Rey Mysterio, Booyaka 619, the reason why I define NFTs as an intangible asset is because Ethereum continues to appreciate, or is likely to continue to appreciate, and your NFTs, while it's still a hot topic, is more likely to appreciate than depreciate, which is why I think when SARS eventually do define what an NFT is, they may define it as an intangible asset and exclude it from definition of personal use assets. Okay? So, that is what I think happens with NFTs. It is not up to me to make a judgment call about, if you ask me any tax-related question about an NFT, that would probably be my answer. If you don't like it, you can get a second opinion. But that is what I think happens to NFTs. Okay, one last piece of trivia. A lot of people think they can get away with doing fancy things with crypto. And like my friend Wogan said, crypto is more traceable and is probably going to be more regulated, or whatever the case may be, whether it's on DeFi, whatever fancy things you do, is probably more traceable than cash. Okay, let me just handle this question on NFT quickly. What about using NFT to generate income with that? Yeah, guys, loss on NFTs be ring fence. No, I think the loss on an NFT would probably be a capital loss. So unless you are trading NFTs as if you're an art dealer, as if you are dealing in NFT art, and it becomes a revenue item, a trading item for you, then it will probably be ring fenced. It depends on how SARS will look at it. I can't say what Treasury will decide about NFTs in the future. Okay, so let's go back to cryptocurrencies, about specifically that they're more traceable. They are extremely traceable. You know what is less traceable than cryptocurrency? Cash. Cash. If I take 100,000 from the bank, not that I have 100,000, I wish I had, but 100,000 from the bank, okay? And then I take 10,000 Rand from somewhere else, okay? And I take 5,000 Rand from somewhere else. Then I stuff that all in a suitcase, and I drive to some person in Bloemfontein, and I give them the 100,000 Rand. no one will be ever the wiser. If that transaction that just occurred there is not recorded on some kind of a bookkeeping, if that's not recorded somewhere, they, who will know? However, if you do the same thing with crypto, it's very likely that your purchases of the crypto that you've did, in order to have those values, in order to withdraw those values or whatever, they will automatically have they will automatically be more traceable than cash. So you can move cash much easier and less traceable than you can move crypto. Yeah, moving crypto to a wallet is not a taxable event. The thing what creates a taxable event is if that coin is... So if you turned... Guys, this is really simple. I don't want to talk about... This is elementary. If you take this is a coin on an exchange, and you put it onto a wallet, but it's still a Bitcoin. So you take one Bitcoin and you put it into a cold storage offline wallet, and it's still one Bitcoin. You have done nothing to create a taxable event yet. Nothing. Okay? Only if you turn this into a lot of other type of coins. Those are capital events, taxable events. Right. I'm done talking now. Let's go over some questions. It doesn't have to be tax related. It can be about anything else. I will we can do 15 minutes of Q&A. If the questions dry up before that, then we can shut down this session on crypto tax. But it's been real. Where can I book a consult? Hey, great question, KK. Let me put the So if you want to book a consult with me to ask me more about NFTs, to declare your crypto, to hide your to hide stuff. If you've got stuff to hide, you're welcome to confide in me. I in fact do want to tell a story quickly. So there was this one guy. He came to me for a consultation, and in the consultation he said he sold 2 properties in 2019, and this was now when I was working at a previous company. And so he sold the 2 properties, and I asked him very simply, did you declare the sale of those 2 properties? And he told me no. I was like, okay. So then I told him, okay, so if you want to become a client of us, or of the practitioners back then you will need to declare your cryptocurrency. Not your cryptocurrency. You need to declare your sale of property. Needless to say, he wasn't that interested in becoming a client, because it meant he needed to pay capital gains tax on the properties that he sold. Okay, so a very simple thing is SARS assumes that you are straightforward with them, that you disclose things with them, that you disclose things properly, and it is taxpayer responsibility to do so. So that's very simple. All those role-playing dice. Yes, Mikai, I love D&D. I'm a D&D player. There's a essential kit box set. I play D&D. I'm I quite enjoy that. I am a dungeon master, so I enjoy that quite a bit. What percentage of tax do forex traders fall into? It depends on how much profit you make on a 12-month period. The more profit you make, the higher your tax bracket is. If you are employed and you are on the 39% tax bracket, for example, your forex profits are taxed at 39%, and there might be a foreign exchange gain between the value at which you bought whatever the forex is. Look, it can be quite complicated, but that's the answer. It depends on what your current what your current forex rate is. Play to earn is the new NFT. Would this be considered part of income? Yes, Rowan. I would, if I was your tax guy, I would probably define it as playing to earn. I would consider that part of income. DS. So the question: how do you prove to SARS that growth of principal amount that you stake is subject of CGT every month you receive interest? Okay, if you receive interest on coins, that type of interest is a normal income item. But the sale of those coins might be considered CGT. Again, ipse dixit, it's how you declare it to SARS. It's how you declare it to SARS. That's and ipse dixit, you must have a convincing argument. If you can't convince SARS, SARS will tax you. You must have a strong argument. Okay. You threw me off of saying this referral. Let's say I hold one Bitcoin for 2 years as a long-term investment, but receive daily referral awards into that same wallet. Will it be income tax? Yes, it will be. How is that hard to understand? If I take R1,000,000 and I push it into APSA or wherever, and I earn interest, referral awards, interest, it's income tax. Guys, tax on crypto is simple. It follows the same logic as other transactions. If it looks like interest, it's probably going to be taxed as interest. If it looks like trading, it's probably going to be taxed as trading. If it looks like a capital asset, it's probably going to be taxed as a capital asset. What is the best way to withdraw an annual amount of 1 bar going forward from my crypto? Should it be done monthly, through a business, or annually? So when you withdraw crypto, you're obviously creating sale events, and that will be capital gains tax. Capital gains tax is the cheapest in an individual capacity, because an individual, the tax rates are 7.2 to 18%. So in a company, the CGT rates are 22.4%. But the frequency, you can do it monthly or you can do it annually. It's not that important how regularly you do it. Yeah. Because your reason for withdrawing is you're just exiting your positions. You are finally selling your investments, because 1 bar is quite a large amount. So if you just take them, you're probably selling your coins. The intent of your coins was probably investor intent, so that would be probably CGT. but it's up to you whether you want to draw down from it monthly or annually. You obviously have to disclose that to your tax person. Can one escape forex tax? Tumaini, can you escape tax? Can you escape pay as you earn? For example. Right. What are your views on fear-mongering articles? Ooh, frack. Zade, thank you so much. Yeah. Who? Let me see in the comments. Who do you think has ever been jailed for non-compliance? I'm not talking about tax evasion, gross tax evasion of millions and millions and millions. I'm not talking about Pablo Escobar. I'm talking about just non-disclosure. Anybody in the comments? More answers. No one. These articles, the fear-mongering articles, are the bane of my existence. I will literally, if for every article that Business Tech or anyone writes and says it's a criminal offense to not disclose blah 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 blah, and then I want to retort and say it's a criminal offense to write tax articles that is this poor. It's a criminal offense to write tax articles in a way that makes people fear SARS and fear the tax man. Come at me. Shoot me. For all I care. Okay? It's a very simple thing of disclosure. That's all what SARS wants. If you disclose something, yay. Okay? The worst that can happen, and the worst I've seen happen on non-compliance, are penalties. And the penalties are a sliding scale of 10% and 200%. And those penalties are on the amount of tax that you should have paid. Which means that if the non-compliance and the non-compliance was on a thing that created a capital loss and there was no tax benefit that SARS or the fiscus would have gotten for the non-compliance, there's no penalty. Because a penalty percentage of 10 or 200% or 10 to 200% on a tax amount of 0 is still 0. The police is not going to knock on your door unless you are driving Ferraris, you live in a mansion, and you have declared nothing to SARS. But you are more likely to have to pay the capital tax amount plus penalties than you are going to have a criminal record. I have not seen people with criminal records, except for obviously the people doing the what do you call it? The excise duty, the drug busts and those things. I have not seen those things. So that's what I think about fear-mongering articles in the media. I hate them with an absolute passion. I hate them with an absolute passion. All right, Tebogo, what is your question, sir? So I think the questions are drying up. But this has been good, guys. Nice. At one point there was 39 concurrent viewers, and now there's 24. Listen, it's been real. Okay, what happens if you receive an airdrop and that was 0 and now it's Okay. The airdrop that came in is obviously might have had a R0 amount value at the time, so that is the base cost 0. Unfortunately, it's now worth 500,000 that you intend to hold as a capital investment. That will be capital gains tax. So if you move that airdrop, whether you take that amount in fiat or you turn that into any, or you turn it, or you take that and turn it into Ethereum and then you turn that into an NFT. Obviously, the moment you turn that airdrop coins that you got into something else, the 500,000, and you do something with it, other than moving it to a cold storage wallet, that will have a capital gains tax, because you said that your intent is to hold it as an investment. And on 500,000, 7.2 to 18%. So, I mean, the most tax that you would pay is probably 90,000 Rand. No, it's a pleasure. Thank you so much. My voice is hoarse now. Could you do a capital loss from an airdrop that loses value after you receive it? Yeah, if you sell it, if you create a taxable, event, so if you then take fiat or whatever, and you made a loss, then you can declare the capital loss. Yeah. Okay. Let me roll a dice here quickly. Forex trader, move all your profit into crypto, then taxed. You're gonna pay profits. You're gonna pay tax on your profits in Forex, and then you move that into crypto. So you've bought crypto. That's a base cost for crypto. And then if you sell those crypto, that will again have CGT. So you are taxed on the Forex event first. And then obviously you are taxed on the crypto second, whatever you try after that. Listen, very simply, Forex is a revenue tax item. There's no way it falls into CGT. It's taxable. That's it. Okay, I'm going to roll a dice, and if it's less than 10, 10 or less, then I'm going to close this stream. But thank you so much for being here. This was amazing. Hey, we rolled a 6. Thanks everyone. Thanks Rash, King, Paul, Tabojo, Zaid, Taran, CJ, Koshik, Tumani, Mikai, everyone. Thank you so much for being here. This is real. Subscribe to Banker X. Check out declaring capital losses, it gets carried forward to the next tax year. So if you make a capital gains tax in the following tax year, then you get then there's then the capital loss from the previous year gets deducted from the capital gain that you made. Okay, I'm gonna end the stream. By the way, for more information, to make a booking, to make a consultant, to ask me any tax question, half an hour is 500 Rand. An hour is 850. If you need tax returns done, I've got a good rate. Check out Tax Maverick. Get onto that site. Book a meeting. Let me help with your taxes. This stuff is complicated if you understand it. Hopefully you got more understanding tonight. Thank you so much, everyone. Have a lekker evening. Cheers.